Hi, this is Alan Gassman. I'm with Brandon Ketron and Kevin Cameron, and we're going to talk today about the newest changes to the PPP program, the ERC program, the Restaurant Revitalization program, and even the Shuttered Venue program. And we're going to do all that in about 30 to 35 minutes. It will seem longer for sure if you try to pay attention. And we have our email addresses here at the bottom. And please send me only easy emails and compliments. The tougher emails to Brandon and the really tough emails to Kevin Cameron. Brandon and I are tax and estate planning lawyers in Clearwater, Florida, trying to get our PhDs in PPP. Kevin is a CPA in Tampa, Florida, who already has his PhD in PPP. We really appreciate the opportunity to help people out and give information here. Please keep in mind that the audience to this morning is a lot of advisors, but also a lot of business owners. So we're going to go a little bit fast here, a little bit slow there. But the first thing, Kevin, what came through your mind when you got an extension that you don't have to file all those returns or estimates, or do you have to file estimates by April 15th? What is the status of the United States of CPAs right now?
A little bit of madness, probably, Alan. So yeah, this week on St. Patrick's Day of all days, the IRS announced that they were going to extend tax season from April 15th to May 17th, and that's now the tax filing deadline for our 2020 tax returns and payments due for 2020. So you can go penalty-free from April 15th, 2021 to May 17th. Unfortunately, as of right now, the first quarter estimated tax payment for 2021 is still due April 15th. So if you make estimated tax payments, you essentially still need to calculate your tax liability for 2020 to determine what your first quarter estimated tax payment will be for 2021. So I'm hoping the IRS extends that date also to May 17th, but as of right now, they haven't. And remember also for our viewers in Oklahoma, Louisiana, and Texas, I believe it is, they have till June 15th because of the winter storms that affected those states. So this May 17th extension did not affect them. They still have till June 15th.
So if anyone lives next door to the Commissioner of the Internal Revenue Service, if he's out there mowing his yard or she's mowing her yard, please just go interrupt them and ask them to change the estimate date to May 17th, and Kevin will appreciate that very much. And you can give them Kevin's email address if they have any questions on this whatsoever. Kevin, what's going on with PPP round 2 loans? Are banks accepting them? Is it too late to send them in? What the heck is going on with that?
Well, you know, Alan, the PPP second draw loan deadline is March 31st, and it got extended, or we think it's going to get extended to May 31st because the House voted, I think, 415-3 this week to pass a bill to extend that for another 2 months. Probably makes sense given the fact that there's still over $100 billion left for funding. What we're seeing a lot of, Alan, right now is a lot of rejections or kickbacks, nothing like we saw in the first round, where lenders and the SBA are asking a lot more questions and checking the data more carefully. There's also a lot of inconsistency in how the lenders are approaching the second draw program. For example, if you base your loan on 2019's payroll and you're with the same lender, the SBA specifically says you do not need to provide any additional documentation to support your average payroll cost because you're using the same number you used in the first draw loan. However, we're seeing lenders ask for that same information. The second thing that we're seeing that's a little disturbing is some lenders, particularly even a few bigger banks, which has us concerned, is telling our clients that they cannot get a PPP second draw loan using the higher of 2019 or 2020's payroll costs, when we know the SBA has specifically told us we can. We've pointed that out to a couple of lenders, and they seem to eventually come around and realize that it's their mistake they're making. So you can see just from these two things alone, there's a lot of confusion still out there with the second draw loan program. And probably lastly, we're starting to see a lot of the banks, I think Wells Fargo might be one, where they're going to stop taking applications really soon. So they look like they want to get out of the PPP business.
Yeah, I know Valley Bank sent me an email on the 15th telling me that they were closing on the 15th. I don't know what happens to the other Valley Bank borrowers, but they're somewhere in the valley. Brandon, where are we on the updated version of the Employee Retention Credit Guide? I heard a rumor that we finished that yesterday.
Yeah, so it is up to date. I don't know if Lissy has the new version yet, but we have updated this for the IRS notice, the American Rescue Plan. So it's up to date through today. If there's anything issued today or in the next week, we'll update again and then get a new version out there. But the update should be available either today or on Monday. So if you've already purchased this, you can re-download it, clicking the same link that you first got it to get the new version, or if you want to get it, Lineberg will send you a link that's always updated with the most recent version. So,
and I'll give you a little trick of the trade. Lineberg Information Services has really good data and information on estate tax planning, asset protection planning, and you can become a member of Lineberg, I believe, for free. Get a trial membership, and then you'll get the discount to get this book for only $159, or if you'll pay us $149, I will autograph it. Okay. Kevin, what's going on with the work with the Excel spreadsheet? I know we have probably hundreds of viewers here on this webinar who are using the spreadsheet. What's new about it? What's exciting?
Nothing really new about it, fortunately, Alan, because so far we've been really lucky with all the new guidance that we've gotten. Most of the new guidance actually has been more like clarifying items and so forth. We're still waiting for SBA to issue guidance on the 4 added expense categories that were provided in the bill that was signed way back now on December 27th. It seems like a long time ago. So SBA hasn't issued any guidance on that yet, so we haven't added the guidance to the worksheet because we don't have it. But otherwise, the worksheet's intact. I think the best thing about this worksheet now is the fact that we have the employee retention credit and the PPP. And I think it's going to be really important for borrowers to be able to show and back up the numbers they're using for their PPP forgiveness versus what they're going to try to use for their employee retention credit. And next Saturday's webinar that I do, I'm going to actually do a case study on that. So I hope everybody can tune in and watch that because it's all about timing. So the good thing about the PPP Excel worksheet, and I just had this experience this week with somebody in California, they were able to edit the worksheet to specify which wages were being used for PPP versus ERC in the expense tracker. They uploaded that exact spreadsheet to their lender. The response back from the lender was, "This is great. Nobody's given us anything like this. Thank you very much." So we really can see that expense tracker is doing its job by backing up the actual numbers you're putting on the forgiveness application.
Okay, and Kevin, what did you cover this morning in the workshop?
Today's kind of covering the recent guidance from last Friday, a week ago Friday, on from the SBA. An update on the ERC, and some IRS new language that came out, especially the extension of the deadline. So it's kind of an update, news and current events type update today.
Okay, and that was at 10 a.m. Eastern Standard Time. So if you did not see that live, you can go to Alan Gassman YouTube channel and look for Tracker or Cameron, and it should be downloaded by the time that you get there, and enjoy these. Kevin's just absolutely brilliant. The spreadsheet is brilliant, and watching the show is a lot of fun, actually. There's also a more comprehensive 52-minute walkthrough that you can go to at YouTube for free, just like Kevin's webinars are. So Brandon, here is, of course, my favorite slide in the whole world, and we're even going to add to it now pretty soon here, restaurants and shuttered venues. But what would you say here as an overall overview for people who are just warming up and maybe have not had their second cup of coffee yet?
Yeah, I think the big thing to at least talk about as far as what's changed in the last couple of weeks is the necessity requirement for second draw loans. Previously, for PPP 1, you had to certify on the application that the loan was necessary to support the ongoing operations of the business. And you were able to get 2.5 times your average monthly payroll cost. If you spend it on forgivable expenses, then the loan's forgiven. It's all completely tax-free and the expenses are tax deductible. That's all been clarified through recent legislation. But for PPP 2, you still had to make the same certification, but you also have to show a 25% reduction in your gross receipts in one calendar quarter of 2020, comparing those back to 2019. I think about on March 3rd, the SBA released some updated guidance that clarified now that if you meet that gross receipts reduction test, so you had a 25% reduction in your gross receipts from one quarter in 2020 compared to the same quarter in 2019, you're going to be deemed to meet the certification regarding necessity. So almost a safe harbor, if you will, that applies for the second draw loan if you're below that 25% reduction. So a lot more borrowers now are less concerned about the necessity requirement and can submit applications for PPP round 2. The employee retention credit, the updated news there is now we have the credit available in both the third and fourth quarters of 2021. So it's extended out. That was the American Rescue Plan Act that just recently passed, and that extended it out to the third and fourth quarters, and also provided 2 new categories of employers that we'll get to. And then there's some special rules that apply to those. If you have a 90% reduction of your gross receipts, you're deemed to be a financially distressed employer and have some special rules. And then if you started your business after February 15th, 2020, and you're a recovery startup business is the term, and your receipts are less than $1 million per year, then some special rules also apply in that case, and we'll go through what those are. Nothing really new on the provider relief fund. There's still not the ability to report the use of your expenses. I don't think they've opened up that application portal yet, so we're still waiting on that to start. And then nothing really new on EIDL programs. The EIDL advance is still available. They refinished the fund with the American Rescue Plan, but they're still targeted to low-income communities and issued first to those that have a large reduction of their gross receipts. So nothing a whole lot new there. So Alan, any other comments on any of those items?
No, but as you know, the necessity requirement for an independent contractor that files a form Schedule C and uses more than $150,000 of gross receipts, or has over $150,000 of gross receipts, and elects to use gross receipts versus net receipts, the necessity requirement is still out there. So makes no sense. Maybe they'll straighten that one out, but I think it bears mentioning. So here is the newest, greatest, most wonderful chart, the Shuttered Venue Grant chart and Restaurant Revitalization Fund. Brandon, do you want to guide us through these?
Yeah, so we'll start with Shuttered Venues on the left side there. And this is a grant program. It's almost similar to the HHS Provider Relief Fund, where you would get a grant. It's a little different calculation. You get 45% of your gross revenues from 2019. You also have to have a reduction in gross receipts, a 25% reduction, again, comparing quarters in 2020 to the same quarter in 2019 to determine your eligibility. You can now also get this with your PPP loan. Previously, the law provided that if you got a PPP loan, you could also get the Shuttered Venue Grant. Now you can get both, but the amount of your PPP loan reduces the amount of the grant. And I think that's important to realize as well, because earlier this week, guidance was released that says if you get your grant before you get your PPP loan, then you can't get the PPP loan. You have to get PPP first and then apply for the grant, so we can determine what your grant's going to be and how is it going to be reduced by the amount of your PPP loan that you got after December 27th. So keep that in mind. Applications are now open, or will be open in the next week or so for the Shuttered Venue Operator grants. April 8th is the deadline. So most people don't have to worry about getting the grant before PPP, because they're going to get PPP first, because that expires on the 31st. and you can't apply to the grant until after that date. But in case they do extend PPP, just keep that in mind. Apply for it first and then get your grant amount. What's eligible? We have some slides on who is eligible for this. It's generally speaking performance theaters, movie theaters, museums, talent representatives, promoters are all eligible. We'll go through that in some more detail in some slides. The same rules apply about duplication of expenses. You can't count wages that you're using with grant money towards PPP forgiveness and vice versa. You have to allocate those across all these programs appropriately and not double count in any way. It is a grant, so if you, it's not a loan that has to be repaid, but you have a certain amount of time currently through the end of the year of 2021 to spend this money on all these eligible expenses. If you spend it on the right things, then it doesn't have to be repaid. If you don't spend all the amount of the grant on the eligible expenses, then you will have to repay a portion of it after December 31st. Independent contractors, if you're, a talent representative or a promoter, you could apply for this grant as well. There's no restriction on that. You can also use it to pay independent contractors up to $100,000. And generally, we can spend this on most eligible business expenses. And there's a few restrictions that will cover. Can't purchase real estate. You can't pay loans that you originated after February 15th. But those are the main guidelines there. The restaurant fund, this applies for bars, breweries, restaurants, any other similar business that has what's known as a pandemic-related loss. And generally speaking, that is the difference between our 2020 receipts and our 2019 receipts. So fairly simple calculation there. There's some different rules if you maybe weren't open the entire 2019 year, but essentially you would annualize your receipts and calculate it that way. There is a necessity requirement. Unlike the venue operator grant, you have to certify that this is necessary to support the ongoing operations, just like you did for your first round PPP. Currently, there is no safe harbor for amounts under 2 million, or if you had a reduction in gross receipts, it's simply a necessity certification. This also works to reduce the amount, is reduced by the amount of a PPP loan, but you can get both. There's no restriction on that. You can't duplicate expenses. It's all tax-free and the expenses are deductible. And again, it would have to be repaid if you don't spend it all on the right items. And that's again, by the end of the year, you have to spend this money. We currently do not know when the applications are going to be open for this fund. There was some guidance released, I think earlier this week, that said it would be weeks and not months before the application would open. So it's going to be relatively soon here. And then as far as when you have to apply, we're not sure when the deadline would be either. And then you have December 31st, 2021 to spend the grant on the eligible expenses. So Alan or Kevin, any comments on those two programs?
I think the most important item on there, especially for the Restaurant Revitalization Fund, is that necessity requirement. I think that they will expand that and maybe even provide us with a test or something to apply, because when you read some of the editorial comments regarding that fund, it really does look like it's supposed to be directed towards high need areas or high need businesses that have been severely affected. And so if even though your revenue might be down for 2020, if you have other resources or other capital, or the business is being operated fairly well and you've actually been able to maybe even turn a profit, you might have a little more of a difficult time getting access to that fund. We'll have to see, because that fund's also got a limited amount that it's allocated, and it's not that significant.
Yeah, it's about $5 billion for restaurants that have under 500,000 a year of gross receipts as of 2019, and about 21 billion for the rest, and it does not include publicly traded companies. So maybe there's just not that many restaurants that still need a lot of money because they got 2 PPP loans. Of course, that second PPP loan is based upon 3.5 times the average monthly payroll, but certainly a nice thing for restaurants. And they did also say they're going to put the money out first for women-owned and minority-owned restaurants and also certain others that might be in difficult zones or something like that. We just posted an article on the Forbes blog on the Restaurant Revitalization Fund, I believe yesterday or the day before, so it's still pretty fresh. If you go to Gassman Revitalization, they're talking about restaurants and not me. Okay, so Brandon, do you want to go through the stimulus bill changes here that we have already mentioned a lot of, but I think just to help people get acclimated, we've got about 10 minutes left here.
Yeah, so I'll just mention the ones that we haven't really talked a whole lot about yet. 501c entities, all 501c entities are now eligible for PPP loans. So that opens up categories to those that are not 3, 4, 6, and 19, which have always been eligible, but now any 501c is eligible. The other news that changed related to nonprofits is the employee limitation, where you have to have less than 300 employees, is now applied per physical location and not as a total group for the nonprofit. If you are a C3, 4, 6, or 19, you had the benefit of an increased threshold of 500 employees versus the 300 that would apply to the other C organizations. They also included qualification for internet publishing organizations, and they topped off the fund with an additional 7.25 billion. So as Kevin mentioned, with funds still available out there in the program and the application deadline coming up, it's pretty likely, I think, that they extend this to make sure that all the funds that are allocated do get used there. We talked about the targeted EIL advance fund being to low-income communities. The restaurant revitalization fund is out there that we've discussed. Shuttered venue operators, ERC extended to third and fourth quarters of 21, and these two new categories of special employers for the employee retention credit. And they are severely financially distressed employers and a recovery startup business. So severely financially distressed employer is an employer that has more than a 90% loss in gross receipts. So it's a pretty severe reduction in gross receipts there to qualify for this. The benefit of this is really only if you're a large employer that has over 500 full-time employees in 2019. Because what applies to the severely financially distressed employer is that you get to count all the wages that are paid to employees regardless of whether they're working or not. So if you're a small employer, less than 500 employers or employees, then that applies anyway. But if you are a large employer, you only get credit if you're paying an employee not to provide any services, essentially stayed at home and doing nothing, unless you're this severely financially distressed employer, in which case you can claim all wages as eligible for the credit. Recovery startup businesses are any business that was established after February 15th, 2020, and gross receipts do not exceed $1 million. And they talk about a 3-year taxable period here, but if we started after February 15th, 2020, we don't have 3 years to look back at. But they did give us guidance and refer to a cross-reference in the statute that essentially what we do is we annualize our gross receipts. And if annualized receipts are less than $1 million, then you qualify as a recovery startup business. So what benefit do they get? Well, they get the credit amount regardless of whether they were suspended, regardless of whether they have a reduction in gross receipts. If you're essentially a startup business that has gross receipts of less than $1 million, you get the employee retention credit for wages paid. Now, it's still capped at $10,000 per employee, so a max credit of $7,000 per employee, and it's limited to $50,000 in total. So a small benefit here to recovery startup businesses, but it is a nice rule to kind of get them off the ground and running. So Alan, Kevin, any comments there or questions?
I think that the recovery startup business allowance for ERC is going to be much bigger than we realized. A lot of small businesses were started last year, believe it or not, and they were kind of left out in the cold, and they were trying to start a business up in the midst of a pandemic. And so now we're going to get a little bit of benefit for those, especially the small ones, because you've got to annualize your revenue to determine whether or not you meet that $1 million threshold. But $50,000 is certainly not bad money for some of these small businesses. So that's a good sign.
Yeah, very nice. Brandon, you want to lead us through the employee retention credit?
Yeah, so a couple of new items here. I think 5 new items to touch on is one, we have really good guidance now on the interaction between the employee retention credit and PPP loan forgiveness. So we know we can't count the same wages twice. So if you use the wages for the credit, they don't count towards forgiveness. If you include the wages on the forgiveness application, you can also claim the employee retention credit. The good news is there's really no election or check the box or anything that you have to do to allocate these. It's just simply, okay, I can't count those same wages twice in any place. So you can work through spreadsheets, you can use Kevin's to do this, you can build your own, but in most situations, I think there's plenty of wages to go around. You just have to make sure you do it properly and account for them. Kevin, any comments on that from a practical standpoint? I know you've probably looked at this for some clients.
Yeah, we've looked at this for a lot of people in the last 2 weeks, Brandon, and really what we're finding is that it's all about the timing. It's all about taking into consideration the limitations and caps on wages. For example, for 2020's ERC, the cap on wages is $10,000 for any one employee for the entire year. So, it might be that you calculate wages for a period of time in which your PPP loan covered period didn't exist, and you maximize those wages for ERC first. Therefore, you retain more wages that could be allocated to the PPP loan. So that's one option. You really have to kind of work on it. It's a lot of work. To do these calculations and figure out whether or not the wages qualify or not. But keep in mind, everybody, that you only have to worry about this issue during the PPP loan covered period. So if you qualified for the ERC before you got your PPP loan and or after you got your after the end of your covered period for a PPP loan, those periods you don't have to worry about because you didn't have a PPP loan or the covered period didn't exist at that point. So again, it's really about sitting down with a piece of paper and a pencil and writing down the dates and the payroll and figuring out exactly which wages allocate to which period. The last thing I'll mention about this, which is kind of interesting, is that the IRS doesn't require you to provide any backup data with the amended Form 941, which is a 941X. They don't require you to even show your numbers. You just tell them what your credit is. So I got a feeling we're going to have a lot of people maybe submitting inaccurate 941Xs, and the IRS is going to come after them necessarily maybe to check these numbers. So make sure that you do a really good job with calculating what wages do qualify for the ERC so that you have the good backup for when the IRS may come ask for that information.
Okay. Very good.
The other thing I'll just mention here on slide 13 is how you claim this credit. So originally, you weren't able to get the employee retention credit if you got a PPP loan. So most PPP borrowers did not claim the credit in 2020. Well, now you're able to retroactively go back and claim that credit because now we can get both PPP and the employee retention credit. And the way we do that is we file an amended 941 for the quarter that we paid the wages. You can't include them on, a fourth quarter return, except for one small, minute circumstance that doesn't apply to most people. But generally, you're just amending the 941 that you previously filed to claim the employee retention credit for those wages paid in the right quarter.
Okay, before we leave the employee retention credit, for both of you guys, we keep getting the same question over and over and over again. The question says, I heard somewhere that I can't take the credit on my own wages if I work for my business. I don't know where that's coming from. People need to stop hanging out with whoever keeps telling them that. But what is that rule, Kevin?
Well, right now, Alan, the rule is that owners' wages probably do qualify for the ERC. Now, some people believe that that's a grammatical error or something along those lines. But I've spoken to the IRS, and the IRS specifically told me that they were that there was no exclusion for them. They did say they were looking into it, so I got to qualify it by saying it that way. But the IRS, gosh, almost a year ago now, provided the FAQs that guided us through the ERC. The ERC is not new; it's just new for a lot of people because they didn't get it if they had gotten a PPP loan, and now they can get it. So the ERC has been around for a little while now, and surely the IRS has had enough time to give us guidance on that. So as of right now, an owner's wages are can be included in the ERC, as well as the spouse if the spouse is working in the business. Now we know the IRS has specifically said other related parties' wages can't be included, even if they work in the business. So we do have some limitations there.
Is it a 10% test, Brandon?
No, it's a 50% or more ownership. So if one party, either directly or indirectly through related party attribution rules, has more than 50% ownership in the company, then individuals related to that more than 50% owner don't qualify for the ERC. But the owner itself is fine, and the owner's spouse is fine. It's only other relatives, so brothers, sisters, sons, daughters, in-laws, step siblings also are included in there. The list is pretty significant, except for the inclusion of the owner and the owner's spouse. But pretty much every other relative is included.
All right. Well, that's fun. Oh, another new chart. God, you're making my morning. Perfect. What's this one?
This is just showing the significance between a large employer and a small employer for purposes of the retention credit. And there's two really rules to be concerned with. If you're a large employer, which is 100 more full-time employees in 2019, or for 2021, it's 500 or more employees, then you only get the credit if you're paying wages for someone who is not working. So if someone is working for 20 hours and you pay them for 40 hours, you can claim the credit towards the 20 hours that they were not working. Or if they just didn't work at all and you paid them part-time for 20 hours of work, then you can get a credit for that. But you can't get the credit for the time that they're working. And then the other rule that applies is for 2020 only, you can't increase their wage more than they were making the previous 30 days prior to claiming the credit amount. So no bonuses, no wage increases to maximize the credit. That doesn't apply for 2021 though. So you can bonus away, maximize this credit all the way up to the $10,000 in each quarter, all the way through the end of the year. Small employers, doesn't matter. You just get the credit if you're paying wages. I think the other important thing to mention here is this isn't a full-time equivalent employee measure like it is for PPP. It's simply you're counting the number of full-time employees that you have. So those that work over 30 hours per week are full-time employees for this purpose. So you just add all those up. You could have 10,000 part-timers and only 20 full-times and still qualify for the credit amount. It's not a full-time equivalent calculation. It's just a full-time employee number as a head count.
Okay, very good. Well, I think we have just 2 or 3 minutes left. So what do I think we've covered Sheltered's venues. Kevin, do you want to take us through restaurant revitalization, or do you want Brandon to, or how do we best spend the last 3 minutes?
I think that we've already talked about the RRF already, but we can definitely hash it out a little bit further and just kind of cover the fact that there's that necessity requirement, which I think is going to be really important. And it's also going to be kind of on a first come, first served basis. So if you are interested in applying for this, you've really got to stay kind of up to tune with what the programs are. Do you need to pre-register so that you can apply for a grant, or is it going to be under a different portal? We don't know any of this information yet, but what I'm trying to tell the viewers is maybe just kind of check it every day might be the thing you need to do with something like this, because I got a feeling when this hits, there's going to be a tremendous amount of influx of applications for this.
Mm-hmm. Yeah, and Alan, isn't there a process that they have to go through and get some sort of number to receive a grant from this fund first?
Yeah, it's in the Forbes blog post that we posted, I think, yesterday, that the American Restaurant Association is having them, you have to go get a DUNS number, whatever the heck a DUNS number is. It probably has nothing to do with a DUNS cap, but that is in the article. If you can't get access to that Forbes article because you're not a subscriber and you've used too many Forbes searches, then have your spouse or friend or child do that. But then if you can't find it, just email me and I'll send you a copy of the revitalization article. Just put the word revitalization in the RE line of the email. Brandon, what do you want to cover last?
Yeah, let's just briefly mention here just the different tests, I think, for PPP and ERC. PPP 1, so you can still get your first draw PPP loan if you haven't got one previously. You don't have to have any reduction of gross receipts to get this. It's just simply, was the loan necessary to support the ongoing operations of the business? And then for PPP 2, we have to have a 25% reduction or more to qualify, and that's looking at the same quarters from 2020 back to 2019. You can also compare that full year, 2020 to over 2019. If you have a 25% reduction, you don't have to break it out by quarter to analyze this. You could just submit tax returns, and I think that's the first step for most PPP borrowers to make the application process a little bit more simple. 50% reduction needed for qualification for the retention credit in 2020, and only a 20% reduction needed for qualification in 2021. Most of the tests are generally the same. Most of the definitions of gross receipts are generally the same. There's some minor differences, but I think that's important to try to keep all these different numbers and different tests of revenue reductions in our head, and we prepared this chart to try to assist with that. So I think that that would be my closing statement.
Okay, and I'm sure the jury would believe you. All right, we have hundreds of pages of PowerPoints here that we fortunately can't get to because it is the weekend and we should do something other than just do webinars on the weekend. But we have really enjoyed presenting this for you. I'm sorry we ran a little bit out of time. Kevin just keeps talking and talking and talking. You just can't get him to stop. But if you do have questions and if you can help us help others, we're more than glad to do that. Special thanks go out to SCORE volunteers. SCORE is an organization that works hand in hand with the SBA to help small businesses get access to these types of programs and other resources. Support your local SCORE member. If they're mowing the lawn, just give them a big thumbs up and say, thanks very much, but keep mowing the lawn. Your lawn needs to be mowed. Thanks again. And I hope everyone has a very, very pleasant rest of your morning and afternoon.